Hello everyone and welcome to today's quickfire revision for Ind AS 103 business combination. Now this is a very important topic and this is definitely one of the top tier 1 category topics which the institute loves to ask, and it is also highly related with topics like consolidation. So business combination is covered under Ind AS 103. There are two distinct parts of the standard even when you refer the study material or our notes, where the initial part is largely linked to the theory and the later part is more linked to the numericals. From an exam perspective, numericals are most important. However, we would cover everything, including the theory as well. So how is business combination defined? Now, business combination has two parts. One is business and one is control. So it is defined as acquisition of control over a business. Now, how is a business defined? Now, business has three ingredients. Business is said to be an integrated set of activities, and assets, that is basically inputs, upon which you apply substantive processes in order to generate an ability to generate output, other income, etc. So basically we are focusing on three essential ingredients. There is inputs along with substantive processes and an ability to generate output. Input can comprise of items like assets, materials, manpower, etc. Processes can be written like operating manuals or training manuals, or it can be a skilled workforce which can constitute a process as well, who knows how to use these inputs in order to generate outputs. And output is generally meant to be revenue. Now you might be a startup who is having an ability to generate an output or revenue. So currently revenue is not yet generated. However, you do have the ability to generate revenue, and hence even if there's an ability to generate revenue, that can be constituted as a business. Now there was a recent amendment, I think a couple of years or a year or so back, where the definition of business has been kind of elaborated a lot more in a lot more detailed manner, though from an exam perspective it is not as significant, but nevertheless we have a separate amendment video, I think in 2021 or so, where this was introduced, but it is not as important. Nevertheless, if you want to kind of understand what is there within business, the standard now says that you can opt for an optional concentration test first. So concentration test would mean that if you are doing a purchase where almost the entire value is concentrated, so substantially all of the value, that is more than 90%, is concentrated into a single asset or a group of similar asset, then you treat it as an asset purchase. Otherwise, you assess whether it is a business. So concentration test says that if almost all your value that you are paying, consideration that you are paying, if that is concentrated into a single asset or a group of similar asset, then it is like an asset purchase. If not, then you assess for business. It does not mean that it is a business by default. Again, this test is optional and hence it is not necessary that you have to apply this. If you don't want to apply this, or if you apply the test and it is not meeting the concentration test, then you assess for business. When you assess for business, you assess whether there exists substantive processes. This is kind of the most important ingredient when it comes to determination of business. Substantive processes can be for entities, let us say, which have an existing output, or entities which do not have an existing output. Why would an entity not have an existing output over here? Maybe because it is a startup and it is not yet generating any revenue or output, or it was generating revenue and now it has kind of ceased or terminated the business, and hence it does not have any output as of now. So over here, in case the entity does not have any output, then you see if what you are taking over is business, that is, are there crucial processes, and are you taking over these crucial or critical processes along with the assets and the organized workforce. So if there is an organized workforce as well which is taken over, then we consider this to be a business purchase. Otherwise, this is still treated to be an asset purchase only. So the existence of critical processes along with the organized workforce and assets will constitute to be a business. Otherwise, it is to be treated as asset purchase. However, if you have an existing output, then you will still see that whether there is crucial processes which are taken over along with organized workforce and assets, that is still considered to be a business, or the processes are so unique or scarce that it is difficult to replicate them. So even if the workforce is not taken over, if what is taken over, that is the processes are so unique, so scarce, like a global worldwide distribution network or presence, that they cannot be replicated, in which case it is still treated as a business purchase. So long story short, in case you want to assess for business, you have to see the existence of substantive processes which can exist for companies which do not have an existing output. If there are crucial processes, and what you take over is those processes along with the assets, liabilities and the organized workforce. In case the company has existing output, again you can say that there is a business purchase if you take over those processes along with the organized workforce and assets, or even if you don't take over the organized workforce, if these processes are so unique or scarce that it cannot be replicated, then it is still constituted to be business. Otherwise it is treated to be an asset purchase. So this is something which is about business. Next you go to control. Now if you look at the institute study material, the definition and the theory for control is actually given under Ind AS 110 on subsidiary. However, we discuss it over here for our overall understanding of the word control. Control under AS would refer to having more than or equal to 50% stake or an ability to appoint or remove the directors on the board. Having said that, under Ind AS, it is not linked to a particular percentage stake. However, there are three ingredients. First, an entity should have the ability to direct the relevant activities. It should have power, so control refers to power, which gives the ability, the current ability to direct the relevant activities. Power comes from rights which are substantive in nature. We will see what substantive rights mean. Second is the entity should be exposed to variable returns. So people like, let us say, the lenders who are exposed to fixed return, or CEO, for example, who's going to get salaries, are actually exposed to fixed returns and not variable returns, and equity shareholders actually exposed to variable returns. And lastly, there should be a linkage between the power and the variable returns. There has to be a linkage between the power and the variable returns. So you should be acting as a principal and not like a CEO or a director who is acting as an agent on behalf of the shareholder. So there are three ingredients for control: power to direct the relevant activities, exposure to variable returns, and a linkage between power and those variable returns. We will focus more on the power to direct relevant activities. This power, remember, arises from arises from rights which are substantive. Now there are two types of rights. One is substantive right and one is protective rights. A substantive right is a right where an entity has a practical ability to exercise. However, a protective right is a right which is just a right which protects an investor. It is not a right through which I can do what I want to. I can prevent others from doing what they want to. That is a protective right, and protective right has to be ignored in the assessment of control. And a substantive right, like for example, if I am holding a convertible debenture, and should those shares that I can potentially get from these convertible debentures, these potential shares, should they be included in the assessment of control? Well, it depends. If I have the practical ability to exercise these convertible debentures, when will I have a practical ability? If the financial impact on conversion is favorable, like the market price is more than the exercise price, in which case it is highly likely that I will convert because I make a financial profit. Or there is an economic incentive, like for example, if I convert, I will get some synergies, that is cost savings, in which case I will like to convert. On the other hand, if the economic impact, let us say, is adverse, like the key management team, which is very crucial to the entity, will leave if I end up converting, then if I want that team to stay, the rights that I hold are actually not substantive because they don't give me a practical ability to exercise. Or if the market price is very low and the exercise price is very high, again it is unlikely that I would exercise in such a case. So in the assessment of control, we will take rights which are substantive in nature, that is, there is a practical ability to exercise. From an exam perspective, if nothing is given, we assume that having a greater than or equal to 50% stake will give control. Second, there has to be a current ability. Current ability means if there is a convertible debenture which can be converted only after 3 years, then I cannot include that convertible debenture into the assessment today because it does not give me the current ability to convert. However, it can be converted at any time during 3 years. Well, then there is a possibility that it gives me a current ability to direct the relevant activities. The relevant activities over here are those activities which most significantly affect the return. Like for example, if there are two partners in your CA firm, and this is not a company, but let us say one of them who's managing audit, tax and all of these revenue generating operations, and another partner is just managing the day-to-day administrative affairs, in which case the partner who is managing, let's say, audit, tax, consulting is considered to be the controlling partner because he is managing or the activities, controlling the activities which most significantly affect the return. If there are multiple parties who control multiple activities affecting return, then there is a possibility that there can be a joint control as well. So this takes care of those relevant activities. Next you have, so we understand hopefully broadly what is business, what is control. Then you go to what is not covered under the standard. Scope exclusion has two items. One is a mere asset purchase, including a group of asset purchase, is going to be accounted for as per the respective standard like Ind AS 16, 38, Ind AS 2, etc. If that group of assets constitutes a business, only then will Ind AS 103 apply. In other cases where it's a mere asset purchase, the respective Ind ASs apply. And second is joint control. If I'm acquiring joint control over a business, there's a separate standard called as Ind AS 111 which guides on the accounting for these joint arrangements. In case control is acquired, control is unilateral, a single ability to direct relevant activities, that is when Ind AS 103 will be applicable. If let us say there are asset purchases, then the difference between asset purchase and business purchases, in the asset purchase you will take over the assets and liabilities at cost. In business purchase you take over them at fair value. In asset purchase, transaction cost which is directly attributed is added to the cost, whereas in business purchase, transaction cost, whether it is direct or indirect, will be taken to the P&L account. Your assets will be shown at fair value only. Under asset purchase there cannot be a goodwill calculation, but in business purchase the difference between the purchase consideration and loosely speaking the net assets can be taken to be the goodwill. Now, what are the illustrations of business combination? Business combination is acquisition of control over a business, and that business can be represented or run by a subsidiary, can be run by a company which is fully acquired and amalgamated, can be run by a company which is absorbed, or a mere division of a company. We don't focus on whether a company as a whole is acquired or not. We say that whether it is an acquisition of business or not. Now there are two set of books. One is the separate financial statements and one is the consolidated financial statements. Most of your questions over here involve the acquisition of a controlling stake in a company which continues to be a separate legal entity. So if it continues to be a separate legal entity, acquisition of, loosely speaking, a greater than 50% stake gives the ability to direct the relevant activities. So through those shares, having more than 50% shares, let's say I acquire a 70% stake, then by virtue of holding a greater than 50% stake, I get the ability to direct the relevant activities of this selling company, and as a result, it is said that I have control over the other company. Now control over here is established in the consolidated financial statements. In case of a holding subsidiary relationship, in the separate financial statements, it is still shown as investment in subsidiary, to which an Ind AS 27 applies, and as per Ind AS 27, investments in subsidiaries, associates or joint ventures in the SFS can be shown either at cost or following Ind AS 109. However, when you do CFS, which is a separate set of books, a separate set of accounts, you will consider assets and liabilities to be taken over for the group as a whole by virtue of the greater than 50% or the controlling stake, as the case may be. So the accounting over here is largely governed by the accounting to be shown in the CFS. Under the SFS, under the holding subsidiary relationship, you will still show investment in subsidiaries. Now, what are the steps when it comes to acquisition of to the accounting of business combinations? There are 6 steps. First is identifying the acquirer. This should be fairly straightforward. Acquirer represents usually the entity who acquires control over a business. Now, most of the times students misread this to be the person paying the PC. Usually, the person who pays the PC also usually acquires control. However, in certain special cases like reverse acquisitions, it may be possible that an entity paying the PC is not necessarily acquiring control. So basically, identifying the acquirer is the entity which acquires control post the business combination. Second is the acquisition date. Acquisition date is the date when control is acquired. It is possible that shares are acquired at various dates, like 20% stake is acquired in 2010, then another 15% stake is acquired in 2012, then another 20% stake is acquired in 2015. Then in 2015, the cumulative stake crosses, let us say, 50%, and hence the acquisition date is not all of these 3 dates when shares are acquired. Acquisition date is a date when control is acquired, which typically arises in our example, let us say in 2015. Acquisition date refers to the date when control is acquired. Third is the more important step, which is purchase consideration. That is a payment made to the owners. Owners are let us say, the stakeholders who appear within the equity section. They can be equity shares or they can be other items as well. As long as they are appearing in equity, they are treated to be owners. The payment to them should be a part of purchase consideration, that is PC. Next, you calculate net assets taken over, similar to what you study in your AS 14 as well, Inter CA. You take over the assets and liabilities of the selling company at fair value. 100% of the assets, 100% of the liabilities, irrespective of the stake acquired. So if I acquire a 70% stake, should I take over 100% of the assets? The answer is yes. That is because I get the ability to direct the entire 100% of the assets. I might be acquiring, let us say, a company who has 100 acres of land. Now, I might have a 70% stake in that company. However, with the 70% stake, I get the ability to direct what is to be done with the entire 100 acres of land. Yes, ultimately, once that land, let us say, is sold or renovated as a case, maybe I will get only 70% of the proceeds. 30% of this will go to someone called as non-controlling interest, which in your CA Inter was called as minorities interest. Step number 5 is determination of NCI or the non-controlling interest. And last step is the calculation of goodwill or capital reserve, or in certain cases, gain on bargain purchase as a case maybe. So 6 steps: acquisition date, acquirer, acquisition date, purchase consideration, net assets, non-controlling interest, and the goodwill determination. Now we'll go into each of these steps in detail. First is identifying the acquirer. As we said, the person who acquires control over a business and not necessarily the person who pays the PC is the acquirer. Acquirer over here can be the person who can be determined to have a relatively greater percentage stake in the post-combination entity. So the person who gets a greater controlling stake in the post-combination entity is the acquirer. So, for example, there is Vodafone and there is Idea. They merge together and form V Limited. And in V Limited, hypothetically, let us say Vodafone has a 60% stake. In which case, Vodafone UK, let us say, is considered to be, let us say, the acquirer in such a case. This can also be evidenced, let us say, by representation on the board or senior management. Who is representing the board or the senior management is considered to be the acquirer. Various things have to be seen. Typically, a larger company acquires a smaller company. Various other things have to be seen. Basically, the person who acquires control in the post-combination entity is considered to be the acquirer. There can be certain cases of reverse acquisition, which may be hidden adjustments, which may have to be seen, in which case the legal acquirer, that is a person who legally appears to be acquiring, actually becomes a target, that is the accounting acquiree, whereas the legal acquiree, that is a target on legal purposes, may become the accounting acquirer. So there is an example over here, and at various places you would have studied about the reverse acquisition. You can refer this example as well for the purpose of determining the reverse acquisition. This is just the theory. Accounting for reverse acquisition is kind of done usually later. Second is the acquisition date. Acquisition date is the date when control is acquired. This is a date when the acquirer gets the ability to direct the relevant activities. There can be various dates in the acquisition process, like the term sheet, the binding offer, the date when board approves, shareholder approves. Basically, the date when, as an acquirer, I can appoint people on the other company's board, I can direct the relevant activities, is considered to be the acquisition date. All other dates are irrelevant. Second, sometimes it might happen that your acquisition date is agreed to be a specific date, irrespective of whether payment has happened, shares are transferred or not. So in case a specified date has been agreed, you will take that. Otherwise, the date when shares are typically acquired, payment is made, is the date when the control is transferred. However, if there's a earlier or later date which has been agreed for whatever reasons, then that can be taken as the acquisition date. Again, to confuse you, various dates may be given in the question. There is a date on the base of which net assets are taken. So PC is determined based on net assets at a particular date. Well, all of that is not relevant. Dividend is accrued to the old shareholders up to a particular date, not relevant. The date when the new acquirer gets the ability to direct the relevant activities is the only date which is irrelevant. Sometimes the acquisition is subjected to a regulatory approval, in which case we have to see whether the regulatory approval is substantive in nature, that is, can it make or break the merger, or it is just a mere registration or formality. In case the regulatory approval is substantive, then the acquisition date can be a date only after the regulatory, on or after the date when the regulatory approval is obtained, not before that. Now, sometimes what can happen is something called a step-up acquisition. So under step-up acquisition, the acquisition, let us say, is kind of happening in tranches, installments, or steps as a case maybe. So the date when the total stake crosses, let us say 50%, is the relevant date for the purpose of acquisition on which Ind AS 103 applies. It applies on a single date only, and that is the date when control is actually acquired. Acha, there is a conflict over here in practical application versus what is there in the institute material. In the cases of code schemes which have been agreed, let us say in practice there is something called as an appointed date, where there is practical guidance available where appointed date is taken as the acquisition date. However, ICI usually takes the acquisition date to be the date when control is acquired, irrespective of the appointed date given in the question. So from an exam perspective, at least as we speak, you should be focusing on the acquisition date as the date when control is acquired. Third step is the step involving determination of purchase consideration. This is where, in my opinion, the real standard from a numerical perspective actually starts. So when you look at purchase consideration, this is a payment made to the owners of the selling company. If the owners are equity, payment made to equity. If preference shares are classified as equity, and payment made to these preference shares will also be a part of PC. However, if preference shares under Ind AS 109 are classified as liability, then payment to preference shares is not a part of PC. However, there can be even ESOP holders, in which case, if ESOP, let's say, is classified as share-based payment or SBP reserve as a part of other equity, then payments made to ESOP holders is also a part of PC. So what all can be a part of PC? Well, cash paid, or the fair value of shares, debentures, preference shares, or any other instruments issued, and even the fair value of non-cash assets issued. Like for example, we might agree to give land as a part of purchase consideration, in which case you will first remeasure the land, take it to fair value, take the difference if any in the profit and loss account as gain on remeasurement, and then take that land at fair value as a part of PC. Or there can also be something called as deferred consideration. Deferred consideration means you don't have money to pay immediately, so if you agree to pay a part of the consideration, let us say into the future, then there is time value involved, because you are acquiring control over the business today. However, a part of consideration you are going to, let us say, pay after 2 years, in which case in your purchase consideration you will try to find the present value of deferred consideration. Here there are no conditions attached, you have to pay, just that you have to pay. Let's say you have agreed to pay 60 rupees today, and you have agreed to pay 40 rupees, let us say, after 2 years, in which case your PC today will be 60, which is paid today, plus 40 into the present value factor at the rate of, let us say, 10% for the second year. So that amount will be taken as, let us say, PC, because that is attributable to payment today. So if instead of paying 40, if an X amount was to be paid today, that would be the present value. So deferred consideration is to be recorded initially at present value, and then it is to be accounted for using the amortized cost method under Ind AS 109 by recording the corresponding finance cost. Then there is something called as contingent consideration. The difference between deferred consideration and contingent is deferred consideration has to be paid, it is just a matter of time, whereas contingent consideration may or may not be paid. So in such a case, contingent consideration has to be recorded for at fair value as on the acquisition date, and subsequently can the fair value change? Well, yes, this fair value change, in case the contingent consideration is classified as a liability, will be accounted for using FVTPL, fair value through profit and loss, and in case there is a subsequent change in the contingent consideration which is classified as equity, in which case you will not remeasure, because equity under Ind AS 109 cannot be remeasured. However, most of the times this consideration is classified as financial liability, and as per Ind AS 109 financial instruments, this is one of those items which will be accounted for as per FVTPL principles. And last over here is in case of ESOPs. Now ESOPs usually have a vesting period attached. So let us say there is a vesting period, for example, of 5 years, and out of which 2 years have been served, in which case we might agree to replace the existing ESOPs by new ESOPs of the new company. Like we agree to replace the existing shares held by the existing shareholders with new shares of the parent company. That is a part of PC. So when I pay shares, my own shares, to the shareholders of the selling company, then my shares which I am issuing is a part of PC. Now shareholders become immediate owners. However, in case of ESOPs, I might agree to issue my shares as a parent company at a concessional price. However, the employee has to render, let us say, 5 years of service, out of which 2 years have been served and 3 years are remaining, and hence what I am agreeing to issue, let us say what I am agreeing to issue is worth 80 rupees. Then in order to earn that 80 rupees, the employee has to give service for 2 years, which he has already given, but he still needs to give service for another 3 years, and hence we will have to allocate. We will have to allocate the consideration of the awards that I am agreeing to give between pre and post combination. A part of this shares are going to be issued because the employee is acting like an owner, because he has already given some service in the past, but a part of it is to be given only if the employee gives service in the future years, which he has not yet given. And as a result, what you will try to do is you will try to allocate the fair value into the pre-combination and the post-combination element, and in your PC determination, you will take only the fair value of the pre-combination allocation in case of replacement awards. So there is some notes over here if you for contingent, deferred consideration, examples, etc. When you look at the replacement awards, which is there in your note 4 over here, the pre-combination allocation can be determined as the fair value of the original award as on the acquisition date into the number of years served, that is 2 years, upon the longer of the original vesting period or revised vesting period. So that will give you the pre-combination allocation, and this pre-combination allocation is a part of PC. When I say as it to be a part of PC, it will be appearing in the acquisition entry, and because it appears as a part of the acquisition entry, it will have a corresponding effect even on goodwill. On the other hand, the balancing figure, so for example, there was replacement awards which were worth, let us say 90, out of which let us say 30 is attributable to pre-combination, then the remaining 60, that is 90 minus 30, is attributable to post combination. So this is calculated typically as a balancing figure, and this is to be accounted for as per Ind AS 102, which is share based payments, which will be accounted for as and when the employee renders service. So this will be recorded as remuneration cost, which will be recorded as and when the employee renders service. So this is attributable to service rendered. This is not issued because the employee is an owner of the selling company. It will be issued eventually after 3 years because the employee renders 3 more years of service to the new company, for example. Over here, you will again need some practice to get used to this concept properly. Now, all that we have discussed is considering the stake or the amount that you are paying on the acquisition date. However, it is possible that the acquirer already holds the stake earlier. So the acquirer earlier held a 25% stake, and now the acquirer is acquiring another 30% stake, which gives him control 25%, which was already there, plus another 30%, and it now has 55%. So for the 30%, cash paid, shares issued, debentures issued, assets issued, contingent consideration agreed, deferred consideration at present value, everything, your ESOPs, pre-combination element of replacement awards, everything will be considered to be a part of PC. But what about the 25% already held? Well, 25% is already held by the acquirer only, and hence that should also be a part of PC. So however, that 25% must be shown in the books of the acquirer as per some standard, like it may be appearing at cost in certain cases, or it may be appearing at fair value if Ind AS 109 is followed, or it may be appearing at carrying value if items like Ind AS 28 associate accounting is followed. So basically, what does the standard say? The standard over here says that at the end of the day, when you read further, you will have to find goodwill as a balancing figure. Goodwill is a balancing figure on the acquisition date, and if you want goodwill as the right number on the acquisition date, all numbers, that is net assets, that is purchase consideration, that is non-controlling interest, everything has to be determined in the fair value as on the acquisition date. Now the 30% stake that you are acquiring is acquiring today only. However, the remaining 25% was already acquired, let us say, a few years back. It may not be at today's value, and hence the standard says you will have to remeasure the existing investment to take it to the fair value, and the difference, if any, between your existing investments carrying value and the fair value will be taken appropriately depending on its accounting. Like if it was under FVTPL, the difference will go to the P&L account. If it is FVOCI, the difference will go to the fair value reserve in OCI. If it is some other item like investment in subsidiaries, investment in associates, joint ventures, which is accounted for using the equity method, then you will remeasure it to fair value and then eliminate those investments, and at the time of remeasurement, the balancing figure will generally go to the P&L, but in certain cases can also go to the other comprehensive income. Again, we have shown examples on this for a better understanding. We are just doing a quick overall revision. Step number 4 is net assets, which we will discuss in some time. But step number 5, sir, what were the steps? Acquirer, acquisition date, purchase consideration, and usually net assets. But before we come to net assets, we would like to discuss about non-controlling interest, NCI. Non-controlling interest, the birth of non-controlling interest is because you are acquiring assets and liabilities at 100%, even though your stake is, let us say, 70%. So ideally, if let us say the parent acquired a 70% stake, like Reliance Industries acquired, let us say hypothetically 70% stake in Reliance Jio, then ideally Reliance should consolidate only 70% of the assets, 70% of the liabilities. However, Ind AS 103 tells you that you'll have to consolidate 100% of the assets and liabilities, because you have the ability to direct the entire 100% of the assets and liabilities. And hence, because you consolidate 100% of the assets, 100% of the liabilities, that gives birth to the concept of NCI, because 30% of those assets and liabilities, though you can direct what is to be done, those 30% of assets and liabilities once sold and distributed belong to someone else, not to you, and hence you create something called as non-controlling interest. So the birthplace of NCI is the fact that you take over assets and liabilities at fair value 100%, and hence the 30% which is not attributable to you is to be shown as NCI. Now, where does NCI appear? NCI, remember, is also at the end of the day owner. It may not be a controlling owner, but it is owner, that is equity. Equity under Ind AS 109 is defined as any instrument evidences residual interest. Over here, even these 30% are going to get residual. If the subsidiary does well, they get more. If it does not do as well, they will get less, but still it is a residual interest, and hence under Ind AS, NCI is to be shown within the section of equity. Under AS, minorities interest was left hanging between shareholders' funds and non-current liabilities. Under Ind AS, it is to be shown as a part of equity section only, not as a part of liability section. Now, Ind AS has two methods to calculate non-controlling interest. First, NCI can be calculated using fair value method. Now, this was not there in AS. Fair value is, you can take, for example, the number of shares that are held by non-controlling interest owners. Let's say there were 1000 shares in the subsidiary, out of which 30% are held by NCI, that is 1000 into 30%, 300. You will go into the stock market and see, for example, the fair market price of each of those shares. We will forget the assets and liabilities that the subsidiary has. We says, what is the market price of these shares? If I had to go to the market and acquire these shares, how much would that be worth? That is the fair market value. You are showing all assets, all liabilities, PC, everything at fair value. NCI can also be shown as a fair market value. So that is one of the methods. The second method over here is calculating non-controlling interest using proportionate net assets method. We will say that, well, share valuation can happen using various methods, like the market price, like the Gordon's formula, like EPS into P, various methods. One of those methods is net assets method, asset minus liability. We say that, well, if I don't want to do a separate valuation of the shares, which is of the subsidiary, which is held by the NCI, I can look at the assets minus the liabilities that I am taking over. I am taking over the assets and liabilities at fair value. So those identifiable assets and liabilities of the subsidiary that are taken over, let's say they are worth 800 crores. So 800 crores into 30%, that is equal to 240 crores. Out of these are attributable to NCI. So you can measure NCI at your NCI's percentage stake of those net assets. So these are the two methods. In the first method, you will record the NCI at fair market value. That is, if I had to go in the market and acquire the NCI, let us say the market price of each share is, for example, 4 rupees. Then if I go to the market today, or if, let us say the market price of each share is, let us say, 1 rupee. If I go to the market and acquire those shares today, then I'll have to pay 300 into 1, that is equal to 300 rupees. Now, it may be possible that NCI's share of net assets is not 300, it is less than 300, maybe even more, but let us say it is less than 300. I may still have to pay 300 rupees, and hence, if I calculate goodwill, I will take the PC. So, in the goodwill calculation, how does goodwill get calculated? Goodwill is calculated as a purchase consideration. Usually, in your inter-se, you compare purchase consideration with net assets in case of amalgamation questions, because you typically take over 100% of the company that is getting amalgamated. However, in holding subsidiary relationship, it is not necessary that you take over 100% of the business, and hence if you compare PC, which is 70%, with net assets, which is 100%, that is not an apple to apple comparison, and hence you compare PC, which is, let us say, for example, for a 70% stake, with net assets, which is for a 100% stake, your answer is not going to be right comparable, and hence you will take PC, which is for 70%, plus NCI, which is for 30%. So for the entire business, 100% of the business, of which 70% have acquired and paid, and the remaining 30% have not yet acquired and paid. However, if I had to acquire and pay, how much would I have to pay today? Let us say 300 rupees, in which case you will take the PC, for example, in this case 700, plus non-controlling interest, for example, over here as 300 at market price, minus the net assets. Let us say this is 800, and hence the difference of 200 comes to goodwill. This is one of the methods of goodwill, which is also called as full goodwill. Second is, so whenever NCI is at fair value, the goodwill calculated is called as the full goodwill. Second is, in case NCI is measured at proportionate net assets, in which case we will say that, okay, the net assets are 800, 30% of that comes to 240, and hence NCI will be 30% of 800, and hence if I take the difference over here, the difference over here will probably come to what? I think 140. So there's a difference between these two. Why is the difference between goodwill arising? It is because of the difference in NCI. So partial goodwill measures goodwill only to the extent of stake that you have acquired. So it is like saying hypothetically that for a 70% stake, you should have paid 800, which is the net assets, into 70%, that is you should have paid 560. However, you paid 700 rupees and hence the difference of 140 is a goodwill for the 70% stake you acquired, partial goodwill, to the extent of stake you have acquired. However, when we look at full goodwill refers to the goodwill of the entire business. Like 70% stake you have acquired, but for the remaining 30% also, if you go in the market and acquire, you will not get it at 240, you will have to pay 300. And hence, for the entire 100% of the business, I'll have to pay 700 and 300, that is 1000 against net assets of 800, and hence the goodwill is 200. Now in the exam, should you follow full goodwill or partial goodwill? Well, in general, institute follows partial goodwill or proportionate net assets based NCI unless the question tells you to calculate NCI at fair value or it gives you specific data through which you can actually calculate your fair market value of the NCI. So in all other cases, you will calculate NCI using proportionate net assets, and hence consequentially the goodwill that will come will be the partial goodwill. Now as we discussed, so as we summarize over here, NCI at fair value will give you the full goodwill, NCI at proportionate net assets value will give you the partial goodwill. Now goodwill over here is calculated as a purchase consideration plus the NCI minus the net assets. That will give you the goodwill. If the difference over here is positive, it is goodwill and you don't need to do any further additional checks. However, if the difference is negative, that is PC plus NCI minus net assets is negative. So for example, if the net assets over here, let us say, were 1500 and you are, let's say, whatever method you take, 700 and 240 minus, so you get a negative number. So this is showing that if you were to acquire the company, you are paying less than the piecemeal dissolution value, like each and every asset. If I take the fair value, what you are paying is less than that. Now this is extremely rare and as per the standard slightly unlikely, because why would a company sell to you at a value which is lower than what it could get if I do a piecemeal dissolution? So hence the standard over here requires you to reassess. It says you reassess and find whether appropriate fair values have been taken for PC, for NCI, for net assets, and even after such a revaluation, if the numbers still continue to be negative, then we see whether there were any reasons because of which the number is negative. If there are reasons which are attributable, like there is a distress sale, like what happened with TikTok in India, it was banned in India, so that is the end of a distress sale. So if there are reasons which are attributable because of which this transaction is happening, then this is called as a bargain, and the difference over here can be called as gain on bargain purchase, which as per Ind AS will be shown in other comprehensive income. It will be accumulated as a part of capital reserve. It is not distributable profit. However, it will be shown through other comprehensive income. Under Ind AS, just for your knowledge, if this was IFRS, the gain on bargain purchase is allowed to be shown in the profit and loss. However, Ind AS believes that that is very aggressive accounting and hence it requires it to be shown as a part of other comprehensive income and then accumulated into the capital reserve. On the other hand, if there are no reasons attributable, then the standard says to tell to the world that it is a bargain is a little aggressive, so we don't show it as a bargain purchase. Still, we take it to the capital reserve. Why to capital reserve? Because it is a profit on purchase. It's not a profit on sale. Typically, if it's a profit on sale, we take it to the profit and loss account. However, this is a profit on purchase, and profit on purchase, we say it is unusual, and hence, it's not something that you show it in the distributable or P&L profits, and hence, as per Ind AS, we can directly add it into the capital reserve as an addition without showing it as a gain on bargain purchase. Okay. A couple of other points that you need to remember before you go to the net assets working is, what if there are directly attributable costs linked to acquisition? The accounting under AS and Ind AS differs over here. If there are directly attributable costs like legal fees, bankers fees, etc., they will directly go to the profit and loss account. They will not be adjusted against the goodwill or capital reserve, unlike the AS. Ind AS rightly so believes that, well, you can't be saying that the subsidiary's goodwill is high because I recruited a big CA firm to help me in my acquisition. No, these are costs linked to acquisition, will not impact the goodwill of the subsidiary and hence should be taken to the P&L. In fact, even indirect costs in getting those assets in your name should be taken to the P&L account. So for example, if you were to acquire control over a company and that company's land is to be now transferred into your name, then you'll have to pay stamp duty on that transfer. That stamp duty will go to the P&L account. You will not capitalize it into the cost of the land because initial recognition of the land will be at fair value and not at fair value plus transaction cost, and hence you will take the direct cost linked to acquisition like the legal fee, banker fee to the P&L, and even indirect cost which is linked to transferring assets into your name also into the P&L account. It will not be capitalized into the cost of the assets and it will not even impact the goodwill in any way. Now the next step is a special adjustment for deferred tax adjustment, which is at the stage of business combination. We will do this along with the net assets working. Again, you will understand this better if you have done the Ind AS 12 or deferred tax standard. So we will come back to this in some time. So when we are looking at net assets taken over, I'll just kind of jump over to net assets, understand this better, and then do the few other special cases. So when you look at the net assets taken over, a few important points that you have to remember: 100% of the net assets are taken over, as we discussed, because we have the ability to direct 100% irrespective of whether we own a 51% stake or a 100% stake. Second, you will take them over at fair value because it is an actual acquisition from a third party. So you will take them over at the fair value, not at the carrying value. If nothing is given, you assume that the carrying value equals to the fair value, but the first preference has to be given to the fair value. Next, you take over assets and liabilities. You do not take over the reserves and capital. You take over the assets and liabilities of the selling company. Reserves by default are not considered to be transferable. They belong to the shareholders of the selling company. The reserves are profits that you will earn as an acquirer when you control the company. The old reserves cannot be taken over. And lastly, you take over all assets and all liabilities that are identifiable, irrespective of whether these assets and liabilities appeared in the selling company's books or not, for which there are a few special cases. Like for example, there can be contingent liabilities. Now the selling company might have disclosed the contingent liability as per Ind AS 37 in the notes. However, when an acquirer takes over a company which has contingent liability, its PC, its calculation will be impacted by the existence of an ongoing lawsuit, and hence, in order to appropriately calculate goodwill, we will record this contingent liability at fair value irrespective of whether it was probable or not at the stage of acquisition. So you will take over the contingent liability at fair value. There may be just a 20% chance. So 100 crore ka payment hai, possibly 20% chance that you will have to make a payment. Still 100 crores into 0.2. That is 20 crores, may be the fair value of this contingent payment, and hence it will be taken as a part of net assets. Contingent liabilities sometimes may be agreed to be indemnified, like the owner or the shareholder of the selling company might say that, well, these are at the end my liabilities and hence I agree to indemnify you. Whatever the lawsuit comes, I agree to indemnify you, in which case you will also create what is called as an indemnification asset. Now strictly speaking, this is a contingent asset, and a contingent asset should ideally, as per Ind AS 37, not be recorded unless it is virtually certain. However, for the purpose of appropriate goodwill calculation, Ind AS 103 says that you can recognize even these indemnification assets on the same basis as the contingent liabilities. Like the indemnification is allowed up to 15 crores. Now you have recorded contingent liability of 20 crores. In which case we will say if 20 crores is the actual liability that materializes, then 15 crores is the indemnification that we can get. So at the stage of business combination, we will record a contingent liability, for example, of 20 crores and an indemnification asset of 15 crores. On the other hand, if the contingent liability was, let us say, 10 crores, in which case, even though indemnification is agreed up to 15 crores, we cannot record 15 crores because indemnification is only to the extent of loss suffered. So if my loss is likely to be 10, then the indemnification will also be 10. So basically, indemnification asset will be recorded at the stage of business combination on the same basis as a contingent liability. So as much of the contingent liability that is getting recorded, utna hi proportionately assuming that liability materializes, indemnification asset can also be recorded as a part of net assets. Subsequent accounting for this contingent liability or indemnification asset will go as per Ind AS 37. However, the standard tells you that you will record this contingent liability at an amount which is the higher of the liability as per Ind AS 37 or the liability at which it is initially recorded till the time it ultimately gets settled. Now, subsequent accounting we have discussed. Next, you go to, let us say, certain other assets like in process R&D or customer relationships or brands, etc., which were not shown in the books of the selling company. However, these items are identifiable, that is, they are separable, or there was a contractual / legal license. However, you could not record that in the books of the selling company because either future economic benefits were not certain or the cost were not measurable, whatever that be. However, at the stage of business combination, you can record and take over these items, whether it is in process R&D or it is customer lists or it is, let us say, brands, at their respective fair value. Subsequent accounting will be still as per Ind AS 38, that is, if you are still in the research phase, subsequent expenses will not be capitalized, it will be taken to the P&L account. Subsequent development expenditure, let us say, can be capitalized. However, at the stage of business combination, you are allowed to take over separately identifiable intangible assets as well at fair value. Secondly, if there is some non-current assets which are held for sale, then the standard says if you intend to sell those assets even after the acquisition, then you take them over at the fair value less cost to sell and not just at fair value. This is regarding non-current assets held for sale. There was another special case that we kind of bypassed earlier, which was on deferred tax, which is very important because it covers two of the most important standards. One is deferred tax and one is business combination. You need to have a reasonably good understanding of deferred tax to understand this adjustment. Over here, at the stage of business combination, you take over the assets and liabilities of the selling company. Let us assume it's a holding subsidiary relationship, in which case, in my consolidated financial statements, I will take over assets and liabilities of the selling company at the fair values. So the carrying value as per Ind AS will be based on the fair value of the assets and liabilities taken over. However, income tax does not recognize consolidated financial statements. Income tax continues to charge tax based on separate PAN numbers for each holding and subsidiary company. So if I look at the tax base, which is the values appearing in the income tax balance sheet, will continue to be the same balance sheet values which were there earlier. So if a separate tax base is given for the subsidiary, you will continue to keep that tax base to be the same. If nothing is given, then you will assume that the old carrying values of the subsidiary will be the tax base. You will not remeasure the tax base to the fair value. And as a result, there can be a potential difference. If there is a difference where the carrying value as per Ind AS, that is the fair values, are greater than the tax base, that is the old carrying values, then the answer is opposite, that is, there will be a deferred tax liability. And if, let's say, the carrying value as per Ind AS, that is a fair value, is less than the tax base, which is the old carrying value, then there will be a deferred tax asset. Why? For example, there may be a 100 rupee debtor appearing in the books of the selling company as per income tax. While taking over, we believe out of 120 is going to go bad, and hence we take them over at fair value, that is 80, which means there is a 20 rupee bad debt which will be permitted as a deduction under income tax in the later years. In the books, there will be no further deduction because you have taken over the debtors at their collectible value, that is 80 rupees only, and hence income tax will give you deduction in the future years for 20 rupees of bad debts, and as a result, that is like a deductible temporary difference of 20 rupees on which a deferred tax asset is created. So as per what we have studied in Ind AS 12, the general principle is that if so these are net assets, that is basically assets. If their carrying value is greater than the tax base, the answer is opposite, so you create a liability, whereas if the carrying value is less than the tax base, the answer is in the same direction, that is a deferred tax asset. Now, how will we know in a question whether this adjustment is to be done or not? Well, there are two things that have to be appearing. First, there have to be fair values and carrying values both of the subsidiary given. In most of the questions, carrying value of the subsidiary is not given, you are directly given the fair values. Second, तभी तो आप difference निकाल पाओगे. You can find the difference only if you have the carrying values and fair values both. Second, you should also be given the tax rate. Sir, we know India में tax rate क्या चल रहा है. No, we don't have to apply all of that understanding. If a tax rate is given and the carrying values and fair values are given, that is when there is a hidden deferred tax adjustment that needs to be done in a business combination sum. That is what you need to remember. Now, for all of these items, there is something called as a measurement period. Now, this is a very good practical relief. What used to earlier happen is, now these business combinations are fairly complex transactions. Now, it might happen that at the stage of acquisition, you do not have all the clear values. So you can actually take over certain assets and liabilities where you need more information on a provisional basis, and hence the goodwill that is calculated is a provisional goodwill. However, it is likely that you will get more information about these items at a later date. So a measurement period is defined. A measurement period is a period which starts from the acquisition date, not necessarily the balance sheet date, the acquisition date, and continues up to 12 months from the acquisition date. Second, if there is any information, if we get additional information pertaining to conditions existing on the acquisition date, then rather than adjusting P&L or anything for those adjustments, you will adjust goodwill. Like for example, you have taken over assets and liabilities on a provisional basis at 500 rupees when the PC was 700, and hence you have provisionally recorded 200 of goodwill. However, new information obtained after the acquisition date, let us say this may be from quarterly or annual financials of the company for the period prior to acquisition, new information points out to the fact that these assets were not really worth 500, they were worth 400, in which case you have actually paid 700, and hence the difference between 700 and 400, that is 300, will be the goodwill, that is 100 rupees will be adjusted against goodwill. So your assets will be reduced by 100 and goodwill will be increased by 100, provided it is a 100% stake. If you have, let us say, an 80% stake, then your assets will be reduced by 100. 80% in a partial goodwill case will be adjusted against the goodwill, and remaining 20% of those assets are attributable to NCI, and hence it is adjusted against the NCI as well. So measurement period adjustments can be asked in the question, in the exam. Okay, so two conditions for this. First, you should have received new information within 12 months. And second, that should give you additional information about something which is existing on the acquisition date. That is when you will do a measurement period adjustment. Now, before we go to the common control combinations and other special cases, there are a few small points that need to be addressed. First, there can be something called as non-replacement awards. About the deferred tax, a few notes are there, you can read that, but the deferred tax asset or liability will be adjusted in step 4, that is the net assets taken over, in order to find the net assets taken over after deferred tax adjustment. Sometimes the tax rate of subsidiary and parent both is given, you will take the tax rate of the subsidiary because you are talking about the assets and liabilities of the subsidiary will be assessed as per the PAN and the jurisdiction of the subsidiary. Okay. Next, there are a few special cases not very important from an exam perspective, like a non-replacement award. What do you mean by non-replacement award? There are ESOPs in the selling company's books, like Tata acquires 100% equity stake in JLR, and JLR had an ESOP scheme. Now, ideally, Tata will take over the ESOP scheme of JLR and agree to issue shares of Tata Motors to the employees of JLR. Now, JLR's employees are British employees. They say we want JLR shares only, and as a result, they don't want any shares of Tata Motors. This is like saying owners of the selling company don't want shares of the purchasing company, so they are not selling, and owners of the selling company which are not acquired by the parent are called as NCI. So this is the same case in case of a non-replacement award. In case of a non-replacement award, it is like owners of the selling company, that is ESOP holders, who do not agree to get options or shares of the new purchasing company. So these are owners of the selling company which are not going to be acquired, so they will be a part of NCI. Now, how will you calculate this as a part of NCI? The same working. You will try to find a pre-combination allocation, like the fair value of this plan as on the acquisition date into the number of years served, vesting period served, upon the total vesting period, original or revised, whichever is longer. The balancing figure will be attributed to post-combination service. Here, instead of crediting the SBP reserve, we will credit the non-controlling interest at the stage of acquisition as well as at each balance sheet date in the consolidated financials. So this is accounting for non-replacement awards. You can refer that. Now, sometimes it might happen that there are components in consideration which is not only attributable to the acquisition. Like, it might happen that there is an existing ongoing lawsuit between the acquirer and the target. Let us say the target was suing the acquirer, and when you acquire that target, in process you are also settling the ongoing legislation. So you might agree to pay 500 rupees to the selling company, but out of 500, maybe 20 rupees is attributable to the settlement of an ongoing litigation, in which case your purchase consideration for business is only 480, whereas 20 is attributable to settlement of an existing non-contractual relationship, because it was a lawsuit, there was no contractual relationship, in which case the difference over here of 20 will be taken separately, and your business combination working will be done based on 480 only. So if there's an existing non-contractual relationship like a lawsuit, then that non-contractual relationship will be measured at the fair value. However, if there's a contractual relationship, like for example, there was a franchisee agreement, and when you're acquiring your franchisee, in process, the existing contractual relationship settles. In which case, again you will have to segregate the consideration, but in case there's a contractual relationship, you will adjust and find the gain or loss on settlement by comparing the settlement value, if any, because in a contractual relationship it may be possible there is a settlement value agreed, or you can compare the fair value with the carrying value and calculate the gain or loss as the case may be on settlement. Sometimes there are also employees which are also owners, so we have to figure out whether if the payment is made to the employees, and one of the condition to these employees who are also owners, so I may be the owner as well as the employee of a company. So let us say the acquirer agrees to acquire my business, and the acquirer says, I'm going to pay you 100 rupees flat and another 20 rupees I'm going to pay you if, let's say, the profits cross 10 crores after 2 years. Well, that's one condition, and second is you continue in service for 2 more years. So the standard over here says that if one of the conditions linked to additional contingent consideration is linked to employee service, then we say that is contingent payment for employee service. Usually contingent consideration is a part of PC, because contingent consideration is assumed to be paid because you are owner of the selling company. However, here among other things, you are told to continue for 2 more years as an employee in the selling company, and hence a part of this consideration is linked to employee service, and hence it will be accounted for as per Ind AS 19 and not as per Ind AS 103. So if there is 100 rupees which is paid flat, it is because I am the owner of the selling company. Whether I continue or not, it does not matter. The another 20 which is linked to employee service will be taken as contingent payment for remuneration of employee service and will be recorded over the remaining 2 years as per Ind AS 19. This is contingent consideration versus contingent payment. Acha. After this, we go to the last few parts of this topic, which is a common control combination, which is governed by appendix to Ind AS 103. Under a common control combination, common control refers to acquisition of control over a business which was ultimately controlled by the same controlling shareholders or the same jointly controlling shareholders, and the common control is not transitionary. This is what they say. So a common control combination, also called as a triple C, involves acquisition of entities or businesses in which all combining entities are ultimately controlled or jointly controlled by the same party or parties, both before and after the combination. And common control is not transitory. It is not just for a small transitory period. Like for example, acquisition of subsidiaries. So if there is a parent and it has 2 subsidiaries, if subsidiary 1 is acquiring subsidiary 2, then on the face of it, it is acquisition of control over a business. However, subsidiary 2 as well as subsidiary 1 are both controlled by the same parent, and hence pre and post combination, the control of subsidiary 2 continues to be the same with the same parent, and hence it is more of a restructuring and not more of a acquisition of control over a business. You are just restructuring your business. And such transactions are to be accounted for using pooling of interest method. So common control combinations are accounted for using a different method that is called as a pooling of interest method. Remember a couple of key points for common control combination. Common control can be if both pre and post combination, the control is with the same individual party if there is control, or with the same jointly controlling parties if there is joint control. Even joint control is considered over here in case of common control combination. Now, the accounting over here is done as per the pooling of interest method. A few important features of the pooling of interest method are all assets and all liabilities are taken over at book values, not at fair values. It is more like a restructuring, and hence it is like you have 2 flats, 2 different flats on the same floor. Earlier there was a wall in the middle, now you are breaking the wall and making it a bigger flat. So this is your pooling, combining, joining your interest, and it is not strictly speaking acquisition of a second flat. It is just pooling or joining 2 separate flats which you earlier had, and hence you will take them over at book values. Now if you are taking over assets and liabilities at book values, then the consideration that is being issued should also be based on the book value, or also called as a nominal value, that is the issue price. At whatever value you are issuing, that will be taken and not the fair value. So net assets are taken over at book values. Even the consideration that is issued is at nominal value or the book value, as the case may be, not the fair value. Third is all reserves or retained earnings are to be taken over. This is the heart, in my opinion, of the pooling of interest method. This is the hardware restructuring is permitted, because otherwise, I mean, if let us say there were two companies, two subsidiaries which were now merging with the parent company, which is an example of a common control combination. If both of these companies had very good reserves, and if both of these companies closed and merged with the parent company, and if these reserves were not allowed to be taken over by the parent company, in which case the parent would be reluctant to do a restructuring, because they would say that then I will lose distributable profits. If they fold up and come into my company and the reserves cannot be taken over as P&L, maybe they appear as capital reserve, then it will defy the purpose of restructuring, and hence in extremely rare cases, reserves are allowed to be taken over, like in the common control combination or pooling of interest method. Reserves are allowed to be taken over in the same form: retained earnings in the form of retained earnings, security premium in the form of securities premium, capital reserve in the form of capital reserve. Reserves can be taken over. If there's a difference between purchase consideration, net assets, etc., then the difference will go in the reserves only. You will adjust it against the reserves. Generally, the standard does not specifically mention that, but it will be adjusted usually against the capital reserve. You will not show goodwill over here, because you can't create goodwill on transacting with your own self. Here, pre and post the combination, the control is with the same entities, and as a result, you cannot create goodwill on transaction with your own selves. However, if the PC and net assets are different, then the difference will be taken into capital reserve, which is called as a gain on loss on restructuring. In practice, it can be taken in other reserves as well. However, for institute perspective, we'll take it as a part of the capital reserve, gain or loss on restructuring. Remember, capital reserve can also have a debit balance. So sometimes it might happen that, like your P&L can have a debit balance, capital reserve can also have a debit balance. You might show capital reserve as a debit balance in such cases. Okay, there will be no goodwill, there will be no gain on bargain purchase. Now, a very special case that institute loves asking at the stage of common control combination is the demerger case. Now, in case of a demerger, what happens is, let's say there is a company X which has two divisions, D1 and D2. It decides to demerge division D2 into a separate company Y. So, X still continues its business with a division D1, and now there's a new company Y which acquires division D2. Now, since Y is acquiring D2, it takes over assets and liabilities. It has to issue consideration. To whom will it issue consideration? Well, it will typically issue consideration to the selling company, which is X Limited. So, if Y issues consideration to the selling company, that is X Limited, now X Limited will own all the shares in Y, and hence Y will become a wholly owned subsidiary of X. So, the division D2, which was pre-combination controlled by X Limited, post-combination is now controlled by Y Limited, but Y Limited acts as a wholly owned subsidiary of X Limited, and hence, in this case, where shares are issued to the selling company directly, the control of D2 still continues to be ultimately with X only, and hence it is a common control combination, even though legally Y is now owning D2. Sometimes what might happen is, it may be agreed that shares are agreed to be distributed to the owners of the selling company, in which case again D2 will be transferred to Y. Y, let us say, will issue shares to X, and X will distribute those shares to the owners, in which case D2 is now controlled by Y Limited and D1 is controlled by X Limited. But if there is a controlling shareholder in X Limited, that same controlling shareholder will also be the controlling shareholder of Y Limited, in which case there is still a common control. So, if PC is distributed in shares and it is going to the shareholders of the selling company, we need to see whether there are any controlling shareholders or not. If there are controlling shareholders, then it is still a common control combination. However, if there are no controlling shareholders, then it is not a common control combination, because let's say there can be 100 shareholders in X, each holding one share each. Those same 100 shareholders will also be shareholders of Y. Now, none of these shareholders control X, because each of them have 1% stake. None of these shareholders also control Y. Remember, for you to have common control, there has to be control in the first place. There is no control in X by any of the shareholders. Well, there is not even control in Y, and hence division D1 is controlled by X Limited, which is a separate legal entity, and division D2 is controlled by Y Limited, which is also a separate legal entity. There is no common control in either of these cases. Are we clear with this? Okay, so this is about the cases of demerger. Demerger accounting can be done in the books of the acquirer or in the books of the selling company. In the books of the acquirer, who is taking over the assets and liabilities, the accounting will be based on Ind AS 103, where if it is a common control combination, all assets and liabilities will be taken over at book values. Shares will be issued at nominal values. But should you take over the reserves, institute does not take over. mainly because in case of demerger, the selling company still continues. If reserves are allowed to be taken over in demerger cases, then it can result in selective transfer of reserves. A company might smartly transfer losses to another company and create distributable profits in its own individual books, and hence usually reserves are allowed to be transferred in case one of the company whose reserves are being transferred kind of closes in demerger. That company does not close, and as a result the reserves cannot be transferred. If the company was closing, which is then not a demerger, then the reserves could have been transferred. So in demerger there is a possibility of selective transfer of reserves, and hence the reserves are not allowed to be transferred in case of a demerger. So you will, as Y Limited, the acquirer, take over the assets, take over the liabilities at the book values, but reserves will not be taken over. If there is a balancing figure, there is a difference, then the difference will be taken into capital reserve, which is a gain or loss on restructuring. However, if there is a business combination, like in case 3, then all assets and liabilities will be taken over at fair value. Then the balancing figure, if any, will be going to the goodwill or capital reserve / gain on bargain purchase, as the case may be. Acha, in the books of the selling company, again, for each of the 3 cases, the accounting can be different. Like in the books of the selling company, debit what comes in, credit what goes out. What is going out is assets, so you will credit the assets at the book value. What is going out is a liability, you will debit the liabilities at the book value. What is coming in, sometimes in case 1, the shares of the new company will come in, so you will show it as investment. So assets credited, liabilities debited, and investment in the selling company to be debited. In case there is a balancing figure, this will also be shown as a gain or loss on demerger. This gain or loss on demerger or restructuring can be taken in the capital reserve, in my opinion. As per here, Ind AS 103 does not apply. Ind AS 103 applies in the books of the acquirer, a person who is acquiring control over a business. Here, in the books of the selling company, GAAP applies, generally accepted accounting practices, and as per GAAP, the standard, you can either take this into the profit and loss account or capital reserve. ICI takes it to the capital reserve, so we also take it to the capital reserve. This is in stage 1. In stage 2, that is option 2, again you will remove the liabilities, you debit the liabilities, you will credit the assets. But in case 2, the piece is directly going to the members, and hence I do not retain any investment, and hence no investment is shown. Balancing figure, if any, will directly be shown to the capital reserve. Gain or loss, as a case may be, on restructuring. In case 3, however, there is a business combination. Now, effectively what this method thinks is, when I am transferring D2 to company Y should actually give X Limited shares, and X Limited is distributing those shares to the owners. So this is like distribution of non-cash assets to the owners. There's an appendix to Ind AS 10 which gives you guidance on distribution of non-cash assets to owners. Usually dividend is paid in cash. However, if you are giving some non-cash asset like a car, or in this case shares of a new company, this is a distribution to the owners, and hence as per that specific instruction in the appendix, you will remeasure all the assets, all the liabilities first at fair value, and then transfer those assets and liabilities. And in case there is a balancing figure, treat this as a distribution. This is one case which the institute does not really dwell on as much, but in case it comes, we have tried to explain this over here, including the guidance for this appendix. Remember, there is a scope exclusion over here. In case 1, there is no distribution only because Y is giving shares to X, X is not distributing it to anyone. In case 2, there is a distribution, however, there is a common control combination, and the appendix to Ind AS 10 excludes that from the scope of distribution of non-cash assets to owners, and hence no working is done in case 2. However, in case 3, there is a distribution of non-cash assets to the owners. The last part of this standard involves accounting for a reverse acquisition. In case there is a reverse acquisition, what do we do? Well, you will first try to identify the acquirer. There may be a hidden adjustment, or the question can tell you that entity B is the legal acquiree but an accounting acquirer, in which case, if it is specifically given, you will first identify the acquirer, then figure out the acquisition date. Then the third step is calculation of PC. PC is typically payment made to the owners of the selling company. Now, typically if entity A was to be acquiring entity B, entity A seems to be the acquirer because it is paying the PC, entity B seems to be the target. However, in case of a reverse acquisition, it is treated as entity B is now the accounting acquirer and entity B is the acquiree, and hence PC has to be inferred based on what would be the payment that B would have made to A's shareholders had B gone ahead with the acquisition. There's a special sum or case that is there, which we have done, I think question 72 or so of our books, and illustration 2 of or test your knowledge 2 of the institute material, which is very interesting. So we have detailed notes over there, you can refer that. Then the net assets taken over. Typically, you take over assets and liabilities. If A legally is acquiring B, you take over assets and liabilities of B. However, accounting wise, B is taking over A, and hence A's assets and liabilities have to be taken over at fair value, and the reserves of B will continue. A's reserves will not appear, the reserves of B will continue, and hence the goodwill will be calculated considering B acquires A. Having said that, in legal terms, A acquires B, and hence if you are asked to prepare balance sheet is prepared in the name of the legal acquirer, that is A. However, it represents continuing financial statements of B, which is the accounting acquirer. Now, this is something which is tricky and is best understood with a numerical only. So, I guess we have tried to cover almost all important facets of this chapter. I hope this video has been helpful to you. Please do share your views and comments, and that should be it for today. I'll see you soon, and till then, have a good day. Bye bye. Take care. Study well, study hard.